I get a lot of people come to me and working out how to use debt to invest. So typically, if you look at Australians that buy property, they go to a bank, they ask a bank for money, and they use a little bit of their own cash, where they might put in 20% of their own cash and borrow 80% from the bank. And therefore, they ride the growth of that property up and they benefit from the growth. In terms of when it comes to investing into stocks, you can do the same things, but people might not have access to that cheap debt from a bank, and you don't want to go and borrow money at 12% as a personal loan. What options are there out there for index investors to actually use borrowed funds to invest to try and get that extra growth if they're a believer?
Yeah, I'm personally passionate about this for young investors. I think that too many people think that the only way to make money in Australia is via property. And if you think about why property investors in Australia have done so well, number one, the asset class has done pretty well. But equally, if not more importantly, is the fact that they are forced essentially to gear at 80% and to regularly repay or service that debt. If you essentially use that approach to any asset class that's a growth asset class, you will do it just about as well. So gearing makes a huge amount of sense as long as you understand it and are sort of happy to take the risk that comes from it, and there is significant risk. Gearing, in our view, makes a lot of sense for a young investor. And recognizing that, we have launched some time ago now internally geared funds, the most popular of which is called GEAR, G-E-A-R. And we've got one over the US market called GGUS. Now, that essentially is internally geared, so you don't have to go to the bank and get any money to borrow. We've done that for you. But better than that, we've done that at the lowest possible rate available to anybody. So we don't disclose the rates every day, but our annual report last year would have shown a gearing rate of sort of circa 80 basis points or 0.8%. For some of the stuff we're talking about, virtually free gearing that's done on your behalf by BetaShares, and it basically gives you exposure to an index of the ASX 200. Geared between 2 to 2.75% of the time. I will say again, these will be very volatile instruments. You do need to be able to ride the ups and the downs. You need to be comfortable with debt, or at least with magnified returns or leverage. But with time on your side and with regular reinvestment into something that's geared, number one, you do benefit from the benefits of gearing. You benefit from the extraordinarily low rate that we've managed to negotiate on your behalf. And because you've essentially got more than 2 times exposure, you get essentially double the franking credits and also double the dividends, although of course those dividends will be reduced by the fees we charge. But it is a pretty supercharged way. Again, I'll repeat, for somebody with a long time horizon, it's a pretty supercharged way to consider getting exposure to the market. So, definitely. on a franking credit basis at the moment, that fund would be paying around about a 10% yield. And on a non-frank basis, it would be paying around about a 7% yield, which, for long-term investors shouldn't matter, but they should be considering just sweeping that back in via a distribution reinvestment plan, the equivalent of a DRP for share investors. And I don't know. I think it's a very interesting way to go. As long as you're willing to take very, very big drawdowns, and it can really get, during COVID, it had a real hit. It had a real hit.